Welcome back to the Dividend Diplomats YouTube channel, guys. You've got Bert and Laney and Bert, B and L, L and B, your favorite dividend investors here on YouTube. He's got the red Buckeyes hat on. He is flexing the Buckeye state right now, guys, and we can't wait. We're going to talk about two stocks that this guy is closing in on 100 shares on. And the question is, should I get there by buying these two stocks?
But before we answer that question, subscribe to the channel. Give this video a thumbs up. You know what, Lanny? I have a thought. We're talking about getting two stocks to 100 shares, but you know what? What happens if we also get this video to 400 likes, Lanny? What do you think
Ooh.
we should do?
Well, when the two powerful forces unite, it looks like we're giving out some of that dividend diplomat swag, baby. We got coffee mugs, we've got t-shirts and hooded sweatshirts, guys. If we get this to 400 likes, subscribe and comment below to enter for your chance to win some DD swag. That would be all time here, brother.
That's right. So, all right, let's talk about these two companies. These are two stocks that you've owned for a while now. I know for a fact you've been building a position in one of them pretty handily over the last year. The other one, we bought a while. I can't remember if you've been adding to it or if you took a little bit of a break. Okay, you have been. You've been feeding both of these positions. And now you're in an interesting position. Do you bring these two companies to 100 shares? I think it's going to be fun to see what these two companies are and just how close you are and how much capital it would take at today's price to get there.
Exactly. And you know, Bert and I, we were chatting, some of the benefits potentially when you get to 100 shares, you could always write covered call options to earn more income, guys. Not here to recommend doing that, but you can if you understand the risks and how to manage those, call options out there. Bert and I, we've kind of been toying around with it every now and again, but that's one of the benefits of what you can do. It gives you that chance or that opportunity to write covered call options since you would own 100 shares and each contract is for 100 shares.
Yeah, and I think the important thing to write while we're mentioning that is we're not telling you to buy 100 shares of any stock just to do it. We're talking about companies that we own, we've bought before, and we at least believe in the underlying asset. So the benefit isn't to write any options or do that. The benefit is to own a quality dividend stock that will help you grow your income. And an extra benefit, a nice little cherry on top of it, is the potential optionality of it.
There it is, guys. So the two stocks we're talking about here, again, filming this on May 21st, a Sunday, a nice 2:30 right now video. Hopefully it's beautiful outside and you guys are able to enjoy some of that sun. But the two stocks, two stocks that I've been building, one maybe more so the other, but definitely over the last, 6, 12, 18 months, United Parcel Services and CVS Pharmacy, if you want to, call it that, or ticker symbol is CVS. So, Bert, if anything, this is like two of your favorite tickers because they match the name.
It is my favorite thing. Everyone knows. We joke around about it all the time. But CVS is a fantastic stock. You and I have both owned this company for a while now. We've owned CBS long before the Aetna acquisition. In fact, when they were a dividend growth stock, they had the pause period. Then they finished the acquisition. Then they started paying down debt. And then they brought the dividend growth back. That's how long we've owned this company. We've been all the way from pause to regrowing the dividend. So, Annie, what is it about CBS that you potentially want to do to keep building this position?
Well, first, I guess to rewind, I own 78 shares of UPS, 85 shares of CVS. CVS is on the list. The metrics will speak for themselves when we quickly go through them. But outside of the Aetna acquisition that they had, 3, 4, 5 years ago, they've also got two big banger acquisitions that they've either closed or completed on. One was Oak Street Health. I believe that was around, 8 to 10 billion. And similar size, I think Oak Street was 10 billion. And they're closing in on Signify Health, I believe around 8+ billion as well. So they're deploying 20 billion, trying to grow their infrastructure and really health. They're all about health and how they could impact consumers from all facets right now.
Yeah, and they're working on cutting down the size of those receipts too to help save on costs. But all right, so we asked the question about CVS. We talked about your your CVS journey when I bought that. UPS, I can't exactly remember when you started buying it. I know when I did, and I feel like it was right around the same time. It was at the beginning of the pandemic is when we really ballooned our UPS positions. You've taken it to the next level though over the last year. You've been buying a lot more UPS, and you've grown it to how many shares, Lanny?
I'm up to 78 shares, which, is a lot when you think about, Bert and his wife's journey to 100 shares of J&J, really around the same type of stock price and
Mhm.
how long and how consistent you have to be to get to 100 shares. I've been buying shares now, again, over the last 12 to 18 months. Give me a moment here. I'm actually pulling up the activity dating back to
Mhm.
January of last year, just so I can get a feel for possibly how much UPS that I've been purchasing.
But
But
you're right
they,
though with this.
yeah, go ahead. Go
I
ahead.
say while you're pulling it up, the journey to get to 100 shares of a stock that's trading at 170 is a lot more difficult than it is for someone like me when I've been even CVS, but also like something like where I bought SoFi, where it was $5 a share. That's a lot easier to get to 100 shares. It's a lot less of an investment, a lot less of a commitment compared to the $170 share price for UPS.
Right. And, the reason why I've been liking UPS is just, everybody's still shopping online. That really has not changed. And if anything, more of that has been happening. People aren't going backwards on their behaviors. So that's part of the reason why I've been scooping up a lot of United Parcel Service over the last, 18 months.
Love it. So just to summarize there, just to make sure I have it, you have 85 shares of CBS. You would need 15 more shares to get to 100. You have 78 shares of UPS, so you need 22 more shares of the big brown truck to do it.
The big brown truck. So since 2022, when I went through my investment account, I've bought 40 shares of UPS. So literally, and it actually began in June of 2022. So we're actually at a full 12-month cycle here. I was at 30, you could call it just 38 shares, give or take.
Yeah,
And
you,
I have added $7,011 buying 40 shares at an average price of 175.
you really ramped this one up, Lanny. So I mean, it's good though. But now you're at that decision point for both of these companies. Do you get to 100 to allow you to potentially write options and cross that 100 share milestone? Or do you pause, look for other companies and work on building up those positions? And I think that's going to be part answer of do you want valuation in there or do you want to look elsewhere? And how else are we going to assess the valuation of a company? The Dividend Diplomat's dividend stock screener, everybody, which has three metrics: P/E ratio less than the S&P 500, two, payout ratio less than 60%, three, history of increasing dividend, where we look at the dividend growth rate and how many years in a row company has increased the dividend. And of course, we'll look at the yield after the fact, after we run through those first three metrics.
Guys, let's get into United Parcel Services, the big brown truck, UPS, trading at $170.93. Projected earnings per share of $10.77. PE ratios below 16 at 15.8, which is very favorable comparatively to the S&P 500. Or what's that dividend payout ratio look like for UPS?
You listen up to me, Jack. Their annual dividend is $6.48. That gives you an annual payout ratio of 60%, brother. That's a perfect payout ratio if I've ever seen one.
Yeah, right at the ceiling, guys. Obviously, outlook may not be looking as promising as the last few years as they're dealing with inflation, maybe reduced consumer spending. Going into the dividend growth, 13 plus years, guys, an average rate of 6.4%. Like the consistency there. The question is, Bert, does it pair well with the dividend yield?
It's like a nice red wine with a piece of steak. It pairs perfectly with the dividend yield. That yield is 3.79%.
Yeah, so you get over a 10% dividend factor with the yield plus the growth rate. Bada bang, bada boom, baby. So, in summary, down 3% this year, down 2% the last 52 weeks, 16 PE, 60% payout ratio, 6% growth rate with a 3.79% dividend yield.
All right, CVS, your turn. Let's get into the ring. Ding, ding. All right, 69.38 is the share price for CVS. Forward earnings are $8.61. That's a super low payout ratio. PE ratio, I apologize, of 8.06. And
They've been trading pretty low. Investors must not like the outlook for CVS right now with possibly taking on more debt for all of these acquisitions here.
mhm.
To look at the payout ratio, is the dividend safe? Could they grow the dividend in the future if they so choose or want to continue onward? because again, we have seen them pause it in the past with the big Aetna acquisition. I mean, the big Aetna acquisition was a little bit bigger than these two.
Yeah.
With the dividend payout ratio, with a dividend of 242 per share per year, again, spread over that quarterly at 60.5 cents. Payout ratio is only 28% currently. So even if you cut earning projections in half, they're still at 56% in that case.
Yeah. And I think that's a really good mark, especially for a company, to your point, that's using cash to acquire, that's using cash, potentially debt even to take on some of these big acquisitions. You would hate to see a payout ratio that would have been like 80 or 90%. That would have spelled trouble, potentially 28%, plenty of room to fund these acquisitions, keep going on earnings, and also rewarding shareholders. But the other side of this is, as we've been saying, we've said this at least 5 times on this video, the dividend growth hasn't been great. They've only increased now for 2 years after that Aetna pause is what we'll call it. And their 5-year average growth rate is 3%. So it's working back the dividend growth. It's a journey. They were doing it before the Aetna acquisition. They stopped it, and now they're bringing it back.
Yeah. And I mean, that's considering a few years of 0%. So the fact that they actually have a 3% dividend growth rate with a bunch of zeros is actually really nice. Now, Bert, even with that, what's that dividend yield now? What's it swelled up to?
3.49%. So it's actually, I didn't even realize it's gotten that high. That's a very nice thing. Obviously, there's not a 10% dividend factor, but hey, 3.5% yield for CVS is very great considering some of their historical dividend yield marks.
Yeah, and I've bought 10 shares over the last, 18 months, more so in 2023. 10 shares at $757 or an average price of $75.76. So, this would be kind of averaging down the last 10 at least, given that they're at $69.38. They're, in summary, they're down 25% this year, down almost 28% in the last 52 weeks. 8 PE, 28% payout ratio. Technically, a couple of years of dividend growth with a 3% growth rate and a 3.49% dividend yield.
All right. So with that, Lanny, here's the question. Again, you need 22 shares to get UPS to 100 because you own 78. You need 15 shares to get CVS to 100 because you own 85 at the moment. Are you willing, at the current valuation, to put in the nearly $4,800 it's going to take to get both of these positions to 100 shares each?
Well, that's a lot of capital. It's a lot of savings that I have to do. I like both stocks where they're at. I don't have 4,800 just to write a check right now to deploy out there on some stocks. But, I don't see why I wouldn't add right now going forward, guys.
All right. So there we have it. Over time, Lanny is looking to potentially build his positions to 100 for CVS and UPS based on the current metrics, the stock screener. I agree, Lanny. I think the journey to 100 shares for each one of them should be something that should definitely be on your radar as a goal this year. Just like the road to WrestleMania, you don't just get to WrestleMania every week. You got to go through SummerSlam. You got to get through you got to build the story arc to get to
Got to get the Royal Rumble, man.
Yeah. Well, yeah, Rumble's coming up. They're coming around the corner, and then you got to get to Mania. So plenty of time for you to get there. So everybody, let us know, what do you think about these two positions? If you were Lanny, would you get them to 100? Let us know in that comment section below.
Yeah, guys. Remember, it's all about saving, investing, and taking steps towards financial freedom, build that passive income. And guys, you're either with us or you're against us. That was Bert and Lanny from the DD, over and out.